Unit 2 is about how economists measure economic performance. If you look at some of the graphs on this page, you can see that there's a lot of different kinds of data that is reported on the US and on other countries. And of course, once you learn about the different kinds of data reporting, you'll be able to use that to look at the data from your country for your economic development project. Today's objective is to explain the phases of the business cycle and what causes an economy to move between highs and lows. First, let's look at the business cycle. You should notice as you look at it that there's a trend line that is pointed upward. Back in the early days when we learned about economics in college, the line for the business cycle was actually shown as a horizontal line. But economists switched over to having an upward slope line to show that overall the long-term trend is toward growth. There are 5 phases of the business cycle. We'll start here with the trough, which is a low point in the cycle. The trough is when an economy has hit a low point, has, for example, very high unemployment, very little economic growth, perhaps even a contraction, but things are starting to look up and the economy is starting to turn around. When the economy first starts to turn around, we call that a recovery. And the recovery lasts all the way up until we hit the peak of the last peak. I guess I should say the last cycle. At that point, the recovery turns into an expansion, and that's when the economy is actually starting to experience growth beyond its previous high. Then we hit a new peak, which is when we've basically maxed out our growth, and we start to see problems like we talked about before, the leading economic indicators. You start seeing things like more unemployment filings, fewer permits to build houses, perhaps declining prices in the stock market. And then we see that the economy is headed for what we call a contraction, and that is the red zone here. And contraction is another word for recession, which is the period when the economy is declining, growth is slowing, growth may become negative. So those are the phases of the business cycle. We simply plot output versus time to see what's happening in the economy. Again, the phases are expansion, peak, contraction, trough, recovery. We did start with trough. I generally like to memorize them this way. Think of expansion, it's growing, peak, it hits the top, contraction, it's shrinking, trough, it hits the bottom, and recovery, it starts to pull out of the trough. How long do each of these phases last? The answer is, it depends. If you look at this data from about 1950 to 2000, you can see a bunch of different recessions, and they lasted for different lengths of time. There was a recession in 1980 that lasted for 6 months, and during that time, real output declined by 2.3%. But other recessions, such as the one in 1973 to 75 and the 81 to 82, lasted for 16 months. So there is no set length for a business cycle. And these, of course, the recessions are just the contraction periods. So the full business cycle would be from, for example, 1973, which would be the start of this recession, all the way up until we hit another beginning of a contraction in 1980. So the business cycle itself might have lasted for 7 years, whereas this one from 1980 to 1981 was a very short business cycle. One of the things that puzzles economists the most, and one of the things that we'd like to understand better so we could try to prevent some of these lows in the business cycle, is what actually causes a recession. One of the major things that is a cause of recession is what we call a burst bubble. A bubble happens when some type of asset or something of value becomes actually overvalued. In our most recent recession, it was the housing market. Housing prices had gone up over a period of at least a decade, and people were speculating on houses. If you read in the textbook, it talks about Fort Myers, Florida as a really good case study. Housing values were getting way out of the range of what homeowners could actually afford. And so people stopped buying houses, and people who had bought houses, in some cases, were unable to make payments and were foreclosed on. And when housing prices started to drop, people scrambled to get out of the housing market and to sell houses, and that caused a decline in consumer spending because consumers worried about the price of their houses. And when consumer spending dropped, businesses thought, well, we don't want to expand now, so business investment dropped, and ultimately that burst housing bubble is what drove us into a recession. Any of those particular things can actually cause a recession. So a drop in consumer spending itself because consumers aren't confident. Perhaps If you look back to 2001 and you look at the attacks on the World Trade Center, that kind of potential for war or disruption can also cause people to lose confidence and stop spending. Businesses may stop investing because of something that's happening in overseas markets, not necessarily what's happening in the US market. And inflation can also cause a recession to start because higher prices put a cramp on what households are able to afford. In the 1970s, the rising gas prices caused inflation and hit many households really hard. People had been used to cheap gas for a long time, and suddenly transportation was more expensive, food was more expensive, everything became more expensive, and people were unable to buy as many goods, and spending on consumer goods actually dropped. The business cycle is actually very, very closely related to the circular flow diagram. And if you look at this, what we talked about with the circular flow diagram is that households own the factors of production, like their labor. They rely on selling those factors of production to businesses in order to earn incomes that they can then spend on consumption. Well, if you think about it, if you're at the peak of a business cycle right here, and then something happens like the dot-com bust, the stock market crash in 1929, the housing market crash in 2007, and households, as I said, become nervous and they stop spending on consumption. You can look over here, household consumption declines, well then business revenues will decline. And when business revenues decline, businesses don't have as much to spend on costs, so they may cut back on their payments to resources, which of course primarily is labor. So businesses might, and this is a subject of much debate, they might cut wages and salaries, or they might simply lay off workers. But in either case, the net effect is now households have less income. So the households are dependent on the businesses for income, but the businesses are dependent on the households for revenue. So when something stops, either the business spending or the household spending, it will have an impact on the other. Households stop spending, businesses stop spending. Now households have less to spend, and we spiral downward through the circular flow the same way that we are going down in the business cycle. Similarly, when a recovery begins to happen, and that perhaps might be because of government intervention, could be because of some new innovation like the invention of cell phones, any number of things can drive recovery and expansion. Typically, it's because of some new type of investment or cheaper resources. So an expansion happens. Now businesses want to hire more workers and expand. Households get more income. Households spend more on goods and services. And that additional revenue that's generated allows businesses to, again, hire more people. So you can see that with each phase of the business cycle, it has ripple effects through the circular flow diagram. If we look at this slide is plotting the civilian employment to population ratio. In other words, what percentage of the population is employed from 1950 to 2010. And I hope you'll notice that it actually looks a whole lot like a business cycle. So we can actually see the business cycle. It's not just a theory. It actually plays out in our economic data. And you can see all these little phases of the business cycle. But you can also notice overall this long-term trend line that we talked about. Yes, there's a huge dip here. Okay, but if we were to plot the last couple of years, we would see that it starts to increase again. This is an interesting sort of magnifying just the last 10 years. You can see that from 2004 to 2008, we were on this very clear trajectory. And the dip, the contraction or the recession that was sparked by the fall of the housing market in 2007 actually dipped us way down here. We actually had a decline in real GDP, huge amounts of unemployment, up to over 10% again. But as we recovered, you'll notice that we have sort of the same, almost the exact same slope in our trajectory, but we're at lower levels of output. So there is actually a long-term impact from a recession. We did not cycle right back up to that earlier trajectory, but we are actually a little bit behind due to the recession. All right, the last few minutes here, I want to talk about another important concept that is going to be carried over into every unit for the rest of this class, and that is this concept of economic growth. And we talked about it a little bit in terms of the GDP growth rate, but I just want to talk about it in really everyday terms, what growth means. So you'll understand it going into this unit when we start measuring GDP and actually, coming up with a way to quantify growth. So economic growth is an increase in the maximum possible output. On the business cycle, it's represented by this upward trajectory. On the production possibilities curve, it is, as we discussed, represented by a shift outward of the curve, the ability to make more capital and consumer goods. Growth is caused by an increase in resources, often driven by an increase in technology, but it could be another type of resource. For example, more petroleum, more natural gas, something else could actually drive economic growth. But it's often driven, as it was in the 1990s, by technology, the internet and cell phones. And economic growth means that we actually have more stuff and we have a higher standard of living. So I want you to think about the 1950s, for example. When Americans look back in the 1950s, they think of that as a time of prosperity. Recovery from the Depression and World War II. People were out buying things. People were moving to the suburbs. People were buying cars. And it was really looked back at as a good time. But if you think about the 1950s, you will realize that our per capita real GDP in 1950 was about $11,000. And this is in constant 1997 dollars. By comparison, in 2009, it had risen to $46,900. So 4 times the real per capita GDP in 2009 that we had in 1950. So the question is, how does our standard of living compare? And I threw a few pictures on here. Obviously, these don't represent everyone in either decade, but there were cars in the 1950s, but cars today are bigger with a lot more features, better gas mileage. There were phones in the 1950s, but they were nothing like our phones today. The average house in the 1950s was considerably smaller than a typical house today. And to look at the data here, in the 1950s, 60% of American families had one car, and only 7% had more than one car. Now, almost all American families have a car. 60% of American families had a phone. Now we have more phones than we have people, literally. 2% of American families had a dishwasher. They had been invented, but very, very, very few people had been able to purchase a dishwasher. Now, almost every middle-class family has a dishwasher. Most apartments have dishwashers. Although microwaves had been invented, no significant portion of American families had one. It was 0%. 10% of families had a TV. And a significant percentage of Americans, I think it's 30%, had never even seen a TV. And of course, no one had a cell phone or home computer. So when you reflect back on the changes in the standard of living, we're not talking about were people happier, were they more content, were families closer. Of course, there's other aspects, but when you think strictly about material goods, the standard of living, our standard of living is considerably higher today than it was in the 1950s. And that is an example of economic growth.